Hello and welcome to the Business Standard Morning Show. I am Thirumay Banerjee. It's the 19th of June 2023 and here are the top stories for the day. Are cartelisation regulatory failure to blame for high airfares? How does India's tutoring industry compare to the world? Are FDs a better bet over equities for the next 1 year? And what is the NDRF? After hitting sky-high levels on busy routes, airfares have reportedly come down considerably in the last few days, thanks to government intervention which had on June 5 asked airlines to self-monitor the ticket prices. The prices had skyrocketed in May after the grounding of embattled Go First airline. But is that the only reason why airfares shot up in the recent weeks? And does that surge point to a regulatory failure? Bhashwar Kumar brings you the answers.
If the recent spike in airfares made you shelve your summer vacation plans, you might want to start looking at hotels and your itinerary once again. The prices of air tickets have come down on most routes. Citing data from aviation regulator DGCA, a government official told a financial daily that compared to June 5th, ticket prices on June 13th for a flight scheduled 1 week later had seen a drop ranging from over 10% to almost 60%. Airfares had skyrocketed in May as demand surged after Go First suspended operations on the 3rd of that month. But on June 13th, the Civil Aviation Ministry said that average spot airfares on 9 routes flown by Go First had declined by up to 33% compared to the week ending June 11th. On the Delhi-Leh, Delhi-Mumbai and Delhi-Ahmedabad routes, the drop in fares was in the range of 26 to 28%. Civil Aviation Minister Jyotiraditya Scindia said that the ministry had intervened by sending strict advisories to airlines asking them to self-regulate fares. He recently tweeted that the DGCA was closely monitoring the matter. At its highest, the one-way fare for a Delhi to Leh flight in May stood above 40,000 rupees, reportedly more than thrice the prices a year ago. And while prices have cooled down from the highs of May, at least as on June 13th, fares on several routes were still reportedly higher than what they were a year ago. Meanwhile, the government recently ruled out any cap on airfares, which are not regulated by it under the current regulations. The DGCA too does not have the mandate of economic regulation in civil aviation. Against this backdrop, a government official told a financial daily that predatory pricing was not the reason for the rise in fares. Instead, a mismatch between supply and demand and the summer travel season were to blame. But the reason behind the spike in fares could be something else. Writing for another financial daily, former Air India Executive Director Jitendra Bhargava recently said that airlines were not operating the number of flights they had themselves offered to fly daily for getting the DGCA's approval for the summer schedule. Airlines get flight schedules approved by the DGCA twice a year, wherein details are given of how many flights they will operate and on which sectors. Bhargava argued that this was a significant contributing factor in the big jump recently seen in spot fares. According to him, in April, when Go First was still operating, India's 10 domestic airlines collectively operated 2,927 flights per day, against the approved 3,273, leading to an average daily deficit of 346 flights. In essence, Bhargava argued that airlines operating fewer flights than committed was the major reason behind high airfares. So, we spoke to Bhargava to understand his argument.
The passengers have been chasing seats of late, so therefore they end up paying more. I'm not going to say that airlines are not justified. The fact is they are, the costs are high, but should you be overcharging? My contention, no. Why is it that there is a scarcity created? And the tragedy is that, well, most experts and the bureaucrats of the ministry understand that when the capacity goes down, the fares go up. Take the example when Go First suspended flights, Minister also echoed the same thing, that the prices are abnormal because Go Air has shut operations. Now, applying the same logic, when the airlines operate about 300 flights less than what they had asked for from DGCA for the summer schedule, does that same logic not apply? That because there are fewer flights, the fares are high.
We also spoke to aviation expert Rohit Singh Tomar to find out what he thought was the reason behind the rise in airfares.
When you file a schedule, you get slots based on the schedule, and the airline needs to operate at least 80% of those slots in a specific season to retain the slot the next year or in the next season. So no, that is not the only contributing factor. Whenever you look at fares, you should look at fares which are return fares. So for example, if you have a flight Bombay Delhi, which is costing you, let's say under your view, it's costing 20,000, which is extremely expensive compared to Bombay Delhi. But you also need to then look at Delhi Mumbai, and Delhi Mumbai would typically be selling at, let's say, a 6,000. So what the airlines are trying to do, what at least what I understand from, I could see the trend, is very similar to international airlines, where there is a unidirectional traffic, in order to incentivize and close the deal on both sides of traffic. So you want passenger on one side, you also want the other flight to be full. So what you do is you try and incentivize a return fare.
According to the Airports Council International, among the top 10 Asia Pacific and West Asia aviation markets, India witnessed the highest increase in airfares in nominal terms across both domestic and international flights. This increase took place between the fourth quarter of 2019 and that of 2022. Coming back to the most recent surge in fares, Jitendra Bhargava has also argued that while the DGCA cannot ask airlines to review fares, it can ensure that the capacity deployed by them matches the schedules approved by it. Against this backdrop, do the experts think that a regulatory lapse has occurred?
Now, if you know that there has been a demand and the market is in a growth mode, and if you still allow airlines to decide how many flights they would like to operate, and not as per the schedule approved, in my opinion, DGCA is failing in its duty. Otherwise, what is the rationale of airlines submitting their flight schedule to DGCA in advance and seeking approval? Government has all the power to ensure that the adequate capacity is deployed by the airlines, and aircraft are not allowed to sit on ground when the fares are rising.
No, I don't think there has been any regulatory lapse. It's not at all right to say that government intervention is required. And let's be honest, what does government do? Every airline, even today, needs to file fare buckets with the government. What the government does is the government does have the right, and it does monitor the buckets that have been put by the airlines. Okay. So there is an indicative number that is available of what is the highest fare that an airline has put in its bucket. And you can see that on any airline website. Every airline website is mandatorily required in India under a separate sheet, which is called the fare sheet. It will show you the buckets of the fares, right? At any given point of time, those fares have to be aligned to, those buckets have to be aligned to.
The experts Business Standard spoke to disagree on the primary reason behind the recent rise in spot fares. And it cannot be conclusively said that either cartelisation, which involves a group of businesses colluding to keep prices high, or regulatory failure are to blame. However, what is known for sure is that if fares rise steeply again, it could become an emotive issue for flyers and a political one for the government.
She'll soon be quoted on the front page. Business Standard.
Gophers 2 plans to take to the skies again by the end of this month. Hope that will bring down the prices of airfares. Moving on, India's tutoring industry is already soaring high. It is no more a fledgling sector. Kota, Delhi, Prayagraj, Chennai, the list of coaching hubs seems never ending. But where do we stand? And how big is India's tutoring industry? And how does it compare to the world? Tushar Verma has the answer.
Tutoring has become a crucial part of students' academic life today. In India, school children go for private tuitions. The higher classes see students joining coaching centers dedicated to competitive examinations such as joint entrance examination for engineering and NEET for MBBS. Then there are coaching centers for civil services examination and common admission test for management studies. With the adoption of online-based education, tutoring has also expanded into the digital world. Startups like Byju's, Upgrad, and Unacademy are now household names. According to Grand View Research, the global online tutoring industry was estimated to be $7.69 billion in 2022. It is expected to grow at a CAGR of 14.9% from 2023 to 2030. India's online tutoring market, meanwhile, is expected to grow by $10.5 billion between 2022 to 27 at a CAGR of 17.03%. According to market research consultant IBIS World, the online tutoring services industry in the US was $1.9 billion by revenue in 2022. Since 2017, the market size has grown at a CAGR of 17.7% in the US. So how exactly does India's tutoring market compare to the world?
K-12 market, rather K1 to K10, is highly fragmented. The other market is for job entrances, very high competition, only 5% get selected. This is a market where people are investing more. You can see there are institutes, the physical institutes whose valuation is more than $1 billion. So this is this case in India where physical institutes are gaining high revenue through these coaching classes. So I'll say that the difference from the world is the competition market. If you see China has a tutoring market of $120 billion and we are still at $18 billion.
The private tutoring market is a different story altogether. Although there is overlap with the online tuition market, especially after the global pandemic, the market was estimated to be $106 billion in 2022, according to IMARC Group. It is growing at an estimated 8.87 CAGR. According to the Annual Status of Education Report Survey of 2022, 30.5% of all students between Standard 1 and 8 in rural India took paid private tuition. In 2018, the share was 26.8%. On a countrywide basis, how common is it for an Indian student to take tuition, especially in comparison to other countries? Arihant Jain of job tech startup Seekho shares a perspective.
Data that I have seen has shown that anywhere from 62 to 76% of students are often enrolled in tutoring. This is a much significantly higher number than most countries and is often attributed to the quality of education that is otherwise prevalent. It is only in India where you have a model such as the quote-unquote quota model. This quota model means that they essentially give up higher school education only to focus on competitive exam tutoring.
The pandemic-induced lockdown aided transition of education from classroom to online mode. According to Traxon, at present there are 11,470 edtech startups in India. The most valued of them is Byju's, which was founded in 2011. In an expanding market, how are edtech companies disrupting the tutoring market? What challenges do they face?
Through online platforms, interactive materials, video lectures, and personalized tutoring sessions, these edtech companies can cater to very different and diverse student needs. The COVID-19 pandemic essentially accelerated the adoption of online learning that perhaps hasn't happened in the last 10 and 20 years. The fundamental problem that we are trying to solve is that the job market moves much faster than the pace of education or education institutes. And that delta is what leads to a difference in how ready any person is when they enter the job market. Roughly 80% of people who graduate from higher education in India are simply not employable because of this gap.
India's tutoring market is highly fragmented, especially at K-12 level. Experts say this is an opportunity for edtech companies. The exam preparation industry, on the other hand, is unique to India. However, the overall tutoring market of the country still falls behind China.
No wonder India's edtech sector has done so well in the last few years. Meanwhile, it seems India's financial markets are not performing that well. Equity investment has delivered negligible returns over the past year. It was close to 1%. And 2023 has so far proved to be a subdued year as investors track the trajectory of global monetary policy. But other asset classes like bank FDs are offering as much as over 9% interest in some cases. Against this backdrop, is it time to turn towards FDs over the near term? Harshita Singh finds out in this report. Even as equity markets continue to hover near all-time highs, returns from Sensex and Nifty benchmarks remain a meager 3% each so far in 2023. The reason? Market experts believe it is due to a sluggish retail investor activity. Discount broker Zerodha CEO Nitin Kamath recently flagged bank FDs as the real competitor for the platform, citing investors' hesitancy towards equities amid higher FD yields. As prospects of lower rainfall due to El Nino continue to pose a risk to a market upside ahead, experts suggest that investors look at fixed income instruments like FDs. FDs remain a better option than equities from a short-term perspective due to their lower risk, capital preservation, and predictable returns. As equities carry the risk of volatility, investors looking for capital protection with an assured rate of return should stick to FDs for a one-year period, says Saurav Basu of Tata Capital. Besides, the halt in the RBI rate hike cycle and the improved liquidity in the banking system suggest that FD rates have likely peaked. However, analysts believe that these rates, currently at 8 to 8.5%, will likely sustain till the end of 2023.
What is important to understand is that while there is a rate pause, it doesn't mean that rates are going to start coming down in the immediate near future. They may hover at around these levels for say a couple of quarters before we talk of a rate cut. So very clearly this rate of around 8.5%, which FD earns, should continue for say maybe till the end of the year before there is any cut that could be thought of. I believe the best thing that one can do is, depending on the age, have a fair mix. So if you are a high risk category person, you could have something like say a 65-35 allocation. If you are a low risk senior citizen type of person, it could be the reverse, 30-70 as a fair allocation.
Hence, conservative investors can allocate more to FDs for stability and liquidity, while more aggressive investors should have a higher allocation to equities for growth potential, experts advise. Today on June 19, market action will remain stock specific. Investors will also take note of the US consumer sentiment data announced on Friday.
He's making plans for an early retirement. Business Standard.
Weather on Dalal Street and beyond has suddenly turned pleasant. It is due to cyclone Biparjoy, which made landfall in Gujarat last week, leaving a trail of destruction at ground zero. But thanks to the personnel of the National Disaster Response Force, or NDRF, the loss of lives was minimal. Thousands were evacuated on time. But what is the NDRF? Ayush Mishra explains.
In a country where nature's fury often strikes without warning, India's National Disaster Response Force, or NDRF, stands tall as the guardian angel to its people. Established in 2006, this specialized force has emerged as the nation's first line of defense against calamities, equipped with the skills, training, and resources to tackle disasters head-on. With their swift response and unwavering preparedness, the NDRF operates under the Ministry of Home Affairs, comprising highly trained personnel from the Central Armed Police Forces, including the BSF, CRPF, ITBP, and Assam Rifles. The NDRF was constituted under Section 44 of the Disaster Management Act 2005 for a response to man-made and natural disasters like earthquakes, floods, cyclones, landslides, or industrial accidents. Section 46 of the Disaster Management Act 2005 also stipulates for a National Disaster Response Fund to meet the expenses incurred during emergency relief and disaster response. The National Disaster Management Authority, or NDMA, is the apex body for disaster management in the country. NDRF consists of 16 battalions with their own dog squads spread across India. It is supported by 28 regional response centers. Women are integral to the force and undergo the same rigorous training as men. Notably, during the Turkey earthquake rescue operation in February, 5 NDRF women participated. It also showcased its expertise on foreign shores during Nepal's 7.9 magnitude earthquake and the 2011 Japan tsunami. The NDRF stands out for its seamless coordination with other agencies and stakeholders during crisis. It works closely with state disaster management authorities, armed forces, and central or state agencies, utilizing advanced equipment, modern technology, and well-rehearsed strategies to save lives and minimize losses. Beyond emergency response efforts, the NDRF places significant emphasis on community engagement and capacity building. The force conducts awareness campaigns, workshops, and training sessions to educate communities about disaster preparedness, risk reduction, and response protocols. The primary objective of NDRF is to save lives and minimize the impact of disasters. During emergencies, the force engages in the swift evacuation of affected populations, conducts search and rescue operations in hazardous environments, and provides medical assistance to the injured. With their expertise and specialized equipment, NDRF personnel have saved countless lives and provided critical support to affected communities across the country. It serves as a specialized force that the country turns to overcome a calamity and come back stronger.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
NDRF personnel are also trained and equipped to respond to nuclear, biological, and chemical disasters. Well, that's all for today. For more news and analysis, please log into business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.